Welcome back to Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. You're here because you understand that in the world of finance, seeing the interconnectedness of events is key to grasping the bigger picture. That's precisely our aim with this deep dive. Today, May 20th, 2025, we're dissecting the crucial headlines from major financial magazines, going beyond the surface to extract the insights that truly matter for understanding current market movements and what might lie ahead.
And we have a really comprehensive set of sources to guide us today. We'll be looking at CNBC's live coverage of Asia-Pacific markets and their daily open newsletter, plus CNN business articles on, the China tariffs and Trump's tax ideas, market watch opinions on that Trump bill and recession indicators, and also Bloomberg pieces covering European versus U.S. stocks, oil price swings, the U.S. downgrade impact, and crypto ownership. And finally, some insights from Yahoo Finance on stock market moves, Fed staffing, and crypto joining the S&P 500. Quite a bit to cover.
A lot to unpack there. So let's lay out the plan. We're going to start over in Asia, looking at how those markets are reacting to China's rate cut and Australia's policy easing. That's from CNBC. Then we'll bring it back to the U.S. markets, look at the Moodys downgrade impact, and of course the U.S.-China trade stuff. Even with this temporary pause, CNN Business has coverage there. Then we'll zoom out a bit on China's economic picture and that interesting debate from Bloomberg about whether European stocks might outperform U.S. ones. Plus the recession question always lingering, right? Market Watch has thoughts on that. And finally, we'll hit some key developments in crypto and tech, pulling from Yahoo Finance and Market Watch. Sound good? Ready to dive in?
Absolutely. Let's start with Asia Pacific. What really jumps out from the CNBC coverage is the generally positive tone overnight. The Hang Seng in Hong Kong, for instance, it surged nearly 1.5%.
Wow, okay.
And mainland China's CSI 300 index, that added over 0.5%.
Yeah.
Even Japan, the Nikkei 225 and the Topix managed gains.
So pretty green across the board.
Mostly. South Korea's Kospi was kind of flat, but the Kosdaq, their small cap index, saw a decent jump, and Australia's S&P SX 200 climbed almost 0.6%.
Okay, so what's driving this? CNBC seems to be pointing towards policy moves from China and Australia.
Exactly. China's central bank, the PBOC, they cut their key lending rates first time in about 7 months. They trimmed both the one-year loan prime rate and the 5-year LPR by 10 basis points.
And the 5-year LPR, that's the big one for mortgages, isn't it?
That's right. So for you following this, it's a pretty clear signal China's trying to, stimulate its economy, give it a boost, especially with those trade tensions still bubbling under the surface. Could mean more volatility maybe, but also potential opportunity if it works.
Makes sense. Trying to get things moving again. And Australia did something similar. CNBC mentioned that too.
Yes, the Reserve Bank of Australia cut its policy rate by 25 basis points down to 3.85%. That's actually its lowest level since May 2023.
Why the cut there?
Their reasoning, according to CNBC, is easing inflation. Headline inflation in Australia hit a 4-year low, 2.4% in the first quarter. So they feel they have room to ease policy without, risking overheating. It's quite a different story than in some other places still fighting sticky inflation.
Interesting. A central bank cutting because inflation is actually receding. And wasn't there some big news in the Hong Kong market too? A battery company?
Oh, absolutely. Contemporary Amperex Technology, CATL, huge player in EV batteries. Their shares jumped over 11% in their Hong Kong trading debut, according to CNBC.
Over 11%, yeah.
Yeah. It's potentially the biggest global listing we've seen in 2025 so far, which is, frankly, quite something given the backdrop. Shows there's still serious investor appetite for the EV sector and maybe for key Chinese tech firms, despite the geopolitics.
Okay, so Asia-Pacific, generally positive on those policy moves. Let's pivot to the U.S. now. CNBC and Yahoo Finance, they reported a bit of a mixed session overnight stateside. S&P and NASDAQ saw small gains. Dow was up more strongly. What's the main thing driving sentiment here?
Yeah, the dominant theme really coming into the week has got to be that Moody's downgrade of the U.S. credit rating, dropping it to A01, taking away that perfect AAA. As CNBC's Daily Open newsletter flagged, that initially sent Treasury yields higher. The 30-year yield even poked above 5% for a bit. So for you keeping tabs on borrowing costs, that's a definite move in the bond market.
A definite reaction there.
Yeah.
But Bloomberg's reporting suggested the stock market kind of brushed off on Monday. Buyers stepped in. Why that disconnect?
That's the million-dollar question, isn't it? Mizuho Securities, cited by CNBC, basically argues the downgrade is, inconsequential for markets. Their point is there just aren't enough large, liquid AAA alternatives to U.S. Treasuries.
Meaning, where else is big money going to go for perceived safety?
Pretty much. They argue it doesn't really change the fundamental liquidity or collateral value of U.S. debt. So the takeaway for you might be immediate market reaction was limited, but those underlying debt concerns, they could still mean higher borrowing costs down the road, affecting everything from mortgages to business investment.
So maybe not much new information in the downgrade itself.
That's another angle, yeah. Bloomberg mentioned that view. Fundstrat's Tom Lee said something similar, that the downgrade didn't really tell the market anything it didn't already kind of know or suspect. Maybe some investors just saw the dip as a buying opportunity.
But not everyone was so calm about it, right?
Hmm.
I think CNBC mentioned Ray Dalio had some concerns.
Yes, Dalio definitely expressed more worry. He suggested Moody's might even be underplaying the risks, especially if the U.S. fiscal path doesn't change or if they resort to, printing money to handle the debt. And Ed Yardeni, also via CNBC, he speculated the bond market might already be looking ahead, anticipating more Treasury supply coming online, maybe combined with hotter inflation, which could keep pushing yields up.
So definitely split opinions on how serious this downgrade really is.
Yeah.
The stock market might seem okay for now, but those long-term debt concerns haven't vanished. Okay, let's shift back to U.S.-China trade. CNN Business is reporting that even with this temporary truce, the impact is still being felt quite strongly.
Absolutely. They agreed to that 90-day pause, rolled back some tariffs. CNN said U.S. tariffs on Chinese goods dropped from 145% down to 30%, which sounds huge.
It does sound like a big drop.
But talking to small business owners like Beth Finbob and Nike from Busy Baby that CNN featured, she still called that 30% tariff awful. Said it adds a massive cost, hurts her competitiveness. It really shows how even a reduced tariff is still a major burden for some.
Yeah, 30% is still a significant hurdle. And it's not just the small guys feeling it.
No, definitely not. The CEO of Walmart told CNN that even for them, the tariffs are just too high to fully absorb, meaning price increases for consumers are likely. It just highlights how widespread the impact is, how it ultimately hits your wallet.
And it sounds like there are some, let's say, creative ways businesses are trying to deal with it. CNBC's Daily Open mentioned something about shipping fraud.
That's right. A growing concern about Chinese exporters, well, maybe understating the value of goods, or mislabeling them to try and dodge the tariffs. Experts warn U.S. businesses working with them could face serious legal risks and penalties. It's a tricky situation. Lots of unintended consequences.
A real cat and mouse game there. Interestingly, the Bank of Singapore, mentioned in CNBC's Asia briefing, actually revised their forecast for the Chinese yuan stronger because of this trade truce.
Yeah, but they also noted that a stronger yuan might cap how much other Asian currencies can appreciate. Just shows how interconnected everything is, how trade policy ripples through currency markets.
It really does. And the trade focus isn't just China, is it? CNBC mentioned Trump wanting some kind of big deal with South Korea.
Yeah, a sort of one-stop shopping deal covering both trade and defense. Experts quoted by CNBC warned that kind of transactional approach could, reframe the U.S. as more isolated, maybe weaken traditional alliances. Something to watch.
Definitely a bigger geopolitical angle there. Okay, let's dive back into China's economy more broadly. We talked about the rate cuts. What's the overall prognosis?
Well, alongside those cuts, Nomura, reported by CNBC, reckons China hitting its around 5% growth target for the year will be tough without a bigger stimulus package. They see a possible slowdown later in the year, maybe after an initial export rush, before tariffs potentially snap back.
So the cuts help, but might not be enough on their own.
That seems to be the view. Though the Bank of Singapore also, via CNBC, did say recession risks have eased for both the U.S. and China because of the truce. So the pause is providing some breathing room, even if underlying challenges remain.
And yet, we saw that massive CATL debut in Hong Kong, largest listing this year, according to CNBC. That feels like a vote of confidence despite the trade worries.
It really does. It suggests investors can still get excited about specific growth stories like EVs, even with the macro uncertainty. And interestingly, CNBC also reported on BC Baby Care, a Chinese baby products firm that's actually ramping up its U.S. expansion. They seem confident, citing supply chain diversification and the strength of the U.S. market. Shows some firms are adapting and pushing ahead.
Okay, interesting resilience there. Now, let's hop across the Atlantic. Bloomberg had a really eye-catching piece suggesting European stocks, the Stocks 600, could potentially outperform U.S. stocks, the S&P 500, by the most in decades. That's a bold call.
It is a bold call, and the analysis coming from big names like JP Morgan and Citi points to Europe's economic outlook may be improving, plus pretty resilient corporate earnings over there. Bloomberg noted that Q1 earnings for MSCI Europe companies actually rose 5.3%, quite a bit better than analysts were forecasting, so perhaps some underlying strength is building in European corporates.
That definitely contrasts with some of the earnings concerns we hear about in the U.S. with tariffs and slowdown worries, and Goldman Sachs is seeing this potential shift too.
Yes, Goldman strategists, according to Bloomberg, expect investors might keep shifting money towards European stocks. A big part of the argument is just valuation. European stocks look cheaper relative to U.S. ones.
Right. Bloomberg mentioned that even though the Stoxx 600 has rallied, its price-to-earnings ratio is still lower than the S&P 500's. So for you as an investor, that PE difference might suggest better value potential in Europe. But they also flag some caution, right?
They did. Strategists like Saujin's Roland Kaloyan want to see more proof, basically. Stronger, more consistent earnings trends out of Europe and less risk around tariffs before really buying into a sustained European rally.
Makes sense. The macro might look better, but company fundamentals need to keep pace. And global trade uncertainty still makes forecasting hard for everyone.
Exactly. It's promising, but maybe not a done deal yet.
Okay, potential European strength noted. Let's come back home and tackle the recession debate. MarketWatch had that headline, "Recession indicators are out of control." Sounds like signal overload.
It really does. MarketWatch highlights how basically everything except maybe jobless claims, retail sales, and, well, GDP itself, which did dip slightly, minus 0.3% in Q1, is being read by someone as a recession warning. It feels like confirmation bias might be running wild.
Yeah, it seems like you can find an indicator for any narrative right now. But MarketWatch did point to some concrete concerns, like mortgage rates ticking up after the Moody's downgrade and household debt hitting an all-time high. Those feel real.
Oh, absolutely. Those are genuine pressures. Higher mortgage rates impact affordability, high debt limits, spending clear potential drags on the economy for you to watch.
Yet, paradoxically, MarketWatch also noted that big banks like Goldman Sachs and JP Morgan actually lowered their recession probability forecasts after the China tariff pause.
Right. It shows how much weight that trade truce carries in some forecasts. Even if it's temporary, it seems to have calmed some nerves about the immediate outlook.
And MarketWatch also poured some cold water on the inverted yield curve, being a perfect predictor this time around, noting it's been inverted for ages without a recession actually hitting.
Exactly. That old reliable indicator isn't looking quite so reliable right now, maybe because of all the weird factors in play, like massive central bank intervention over the years. And they also noted the U.S. jobs market, while maybe not booming, is still reasonably healthy. Unemployment is still low.
So really, truly mixed signals on the recession front. More uncertainty than clarity right now. Okay, let's switch to tech. Nvidia made a move that MarketWatch called very smart, NVLink Fusion. What's the significance there?
Yeah, this is pretty interesting stuff in the chip world. NVIDIA's NVLink Fusion basically lets data centers mix and match custom chips from other companies with NVIDIA's own AI gear.
So opening up their system a bit, making it play nice with others. Why is that smart?
Well, analysts quoted by MarketWatch think it's about keeping NVIDIA right at the heart of all that AI data center spending. Even if a company uses custom CPUs or whatever from someone else, this NVLink Fusion means they'll probably still need NVIDIA's powerful GPUs and networking to tie it all together for demanding AI work.
So they become the essential plumbing, even if they don't supply every single part.
Exactly. It potentially broadens their reach, keeps them indispensable, and might even open doors to sell more of their software and services down the line. Big names like MediaTek, Marvell, Qualcomm are already partnering up.
That does sound strategically savvy, positioning themselves as central to the whole AI ecosystem. And they also launched new servers, RTX Pro.
Yes, these are aimed squarely at getting AI adopted more widely within businesses, enterprise environments. MarketWatch suggested this, maybe combined with potential tax breaks for capital spending, could really speed up AI adoption across industries.
Okay, let's shift to oil now, always volatile. Bloomberg reported some sharp swings after comments from Iran's leader about the nuclear deal.
Yeah, those comments threw some cold water on hopes for a deal that could bring more Iranian oil supply back online. As Bloomberg noted, oil prices have been jumpy lately. They dropped hard in April, then bounced back in May, partly on hopes the U.S.-China trade truce would boost demand.
So more supply uncertainty.
Exactly. Any sign of more oil hitting the market, whether from Iran or maybe Russia still finding ways around sanctions, could push prices down again, especially since the market's kind of expecting a surplus later this year anyway.
Geopolitics driving the oil bus, as usual.
Right.
And Bloomberg also mentioned Trump apparently backing away from pushing for a quick end to the Ukraine war, adding more uncertainty.
Precisely. Another layer of geopolitical instability that tends to ripple through commodity markets like oil, making investors nervous about supply and demand dynamics.
Right. Now, a major domestic issue, Trump's tax cuts and the debt. CNN Business reporting this is back in focus after the Moody's downgrade. What's the latest?
Well, CNN highlights this kind of jarring situation where right after Moody's explicitly cites debt problems for the downgrade, House Republicans push forward with this big bill, Trump's big, beautiful bill, that estimates suggest could add over $1 trillion to annual deficits.
Seems counterintuitive timing, to say the least. Is there debate about whether it actually will add to the debt?
Oh, absolutely. Some former Trump officials, CNN reports, argue it won't, claiming cuts to waste and fraud will pay for it. But, given the downgrade and the stated concerns about debt, investors and rating agencies are likely to be, shall we say, highly skeptical. They'll be watching the fiscal math very closely.
And MarketWatch, in an opinion piece, really hammered home the role of the bond vigilantes here.
Yeah.
Saying the bond market will ultimately decide the fate of this bill. That's crucial for you as an investor to understand, right? The bond market's power.
Absolutely. Critical insight. Brett Aarons at MarketWatch argues that, politics aside, if the bond market hates this bill, sees it as fiscal or reckless yields could spike. He even mentioned a potential trust moment, recalling how fast markets turned on the former UKPM's plans.
A trust moment. Ouch. And MarketWatch laid out the potential fallout from rising yields. Higher government borrowing costs, higher rates for companies and consumers, maybe even stocks looking less attractive compared to bonds. It really shows the leverage the bond market has.
Exactly. The U.S. government needs to borrow huge amounts, so it's very sensitive to what bond investors think. If they demand higher yields because of fiscal policy fears, it hits everyone, the whole economy.
Okay, let's pivot to crypto. Yahoo Finance had that headline, "Everyone owns crypto now, which feels safer amid the chaos." A shift in perception, maybe. What's happening there?
Well, a huge development they highlighted is Coinbase, the big exchange, getting added to the S&P 500 index. That's a major milestone, signals crypto becoming more, mainstream, integrated into traditional finance.
Big validation for Coinbase and maybe the industry.
Definitely. And Coinbase's stock has done very well recently, reflecting that. So for you, it could suggest broader acceptance is growing for crypto and related businesses.
And even Trump is getting more involved.
Yeah, Yahoo Finance reported he hosted a dinner for top buyers of his Trump crypto token. Certainly raises eyebrows, this intersection of politics and digital assets.
A unique situation, for sure. What about Bitcoin itself? Is the narrative changing?
Yahoo Finance noted that some crypto bulls, maybe encouraged by things like the Coinbase S&P inclusion, are arguing Bitcoin is finally acting like that inflation hedge or digital gold they always talked about, especially with stock market jitters.
What is it?
Well, the article wisely advises some skepticism. Bitcoin's history is still super volatile, and its correlation with inflation hasn't exactly been reliable or consistent, so the jury's still out on that one.
Okay, fair enough. Switching again, the Federal Reserve. Yahoo Finance reported Fed Chair Powell plans to cut the Fed's workforce by about 10% over the next few years. Why?
According to Powell's message to staff, reported by Yahoo Finance, it's about efficiency, consolidating functions, modernizing, making sure the Fed is right-sized for its mission today. It'll mostly happen through attrition, early retirements, not layoffs, similar to something done back in the Clinton era.
And Yahoo Finance noted this doesn't seem to be direct pressure from the Trump administration, despite their push to streamline government.
Apparently not directly driven by that, no. And Powell himself, as Jennifer Schonberger's article on Yahoo Finance reminded us, has been pretty vocal, consistently calling the U.S. fiscal path unsustainable. Strong words.
He has been consistent on that. And we also heard from Atlanta Fed President Raphael Bostic recently, via CNBC, leaning towards just one rate cut this year.
Yes, citing the impact of tariffs as a key reason. Shows the Fed is really wrestling with both inflation risks and the economic effects of trade policy when thinking about rates.
Okay, finally, let's wrap with the latest market moves. Yahoo Finance said U.S. stock futures dipped a bit Tuesday morning. What's the thinking there?
Seems like a bit of a pause, maybe some profit-taking after the rally we saw, which was partly fueled by that trade truce relief. There are worries creeping back in, echoed by people like Jamie Dimon, according to Yahoo Finance, that maybe investors got a little too optimistic about the trade situation calming down. The underlying risks haven't disappeared.
So, focus shifting back to fundamentals, like earnings. Home Depot reporting soon.
Exactly. How are tariffs really hitting companies and consumers? That's the question. And MarketWatch also just threw shade on that old technical signal, the S&P 500 crossing its 200-day moving average, saying historically it's not actually a reliable buy signal.
So maybe the market's just catching its breath, reassessing things after the recent good news on trade, realizing the uncertainties are still very much there.
I think that's a good way to put it. The initial relief rally might be giving way to a more cautious wait-and-see approach as investors digest everything.
Okay, let's try and pull this all together. We've covered a huge amount of ground in this deep dive today.
Hmm.
We saw Asia-Pacific markets react to policy easing in China and Australia. We looked at the ongoing, complicated impact of U.S.-China trade, even with the pause. We unpacked the market's initial shrug towards the U.S. credit downgrade, but also the deeper worries underneath. We explored that potential divergence between European and U.S. stocks, wrestled with all those conflicting recession signals, touched on Nvidia's smart strategic moves in tech, and highlighted how fiscal policy and the bond market remain incredibly powerful forces.
And as we've discussed, all these things are connected, aren't they? What happens in China affects the US, affects Europe, affects commodity prices. Understanding those links is really key to seeing the whole financial picture for you trying to make sense of it all.
So here's a final thought for you to mull over today. Given all these mixed signals we've talked about, the trade uncertainties, the debt concerns, potential regional shifts, conflicting economic indicators, how should you, as an investor, think about balancing the search for short-term opportunities against managing these very real long-term risks in this constantly shifting landscape? It's definitely something to think about.
It really is. Navigating times like these requires a lot of careful thought, staying informed, and probably a healthy dose of critical thinking about all the headlines.
We'll see you all tomorrow morning with new headlines from major financial magazines.